Sterling Bank PLC of Nigeria has announced it has also received the central bank approval in principle to enable it to restructure as a holding company. The bank said its desire to operate as a holding company was driven by its plan to spin off its non-interest banking window, which became operational in January 2014, into an autonomous entity. The bank believes that the proposed structure incorporates efficiencies around operations and financing efforts that will support the individual business in reaching full potential. Holding company is designed to operate on three major premises for Sterling Bank: that's specialization, partnership, and digitization. So what does this all mean for Nigeria's banking sector? Joining me to discuss this is Wale Olusi, Head of Investment Research at United Capital PLC. Good morning to you, Wale. What do you make of Access Bank, Sterling, even GTB, all announcing recently that they intend to restructure into HoldCos?
Thank you for having me, Reuters. Yeah, I think it's a new trend that we've just noticed. Initially, we thought, GT was the only one that was making that move, but clearly it's becoming an industry trend now. First off, I think it has to do with, one, the changing dynamics in the macroeconomic environment. Apart from GT that has given details about what their own HoldCo would look like, that includes an asset management business, it includes a pension business, but more importantly, it also includes, a fintech subsidiary. What we've noticed from what Sterling is saying, and most likely what Access will be doing as well, is that you are going to have a fintech subsidiary, as part of what all of these banks are going to create out of this new structure. So I think the changing dynamics in the market, the increasing amount of opportunities in the fintech space, with this pandemic, ICT, technology, telecoms clearly, seems like the future. So, I think that's one big area that is driving this trend. I think regulation is also driving trend, because with an HoldCo, you can reorganize your business, and you will know which one is susceptible to regulatory pressure from agencies such as the central bank.
Okay, great stuff. So thank you. So will we soon see this across Nigeria's entire banking sector?
Well, where are we coming from? We are coming from, a system of universal banking, sector in Nigeria. Before Governor Sanusi, what we used to have was a universal banking, where a bank is basically a supermarket. You sell all sorts of financial solutions. But when Sanusi came, he said, no, if you want to be a bank, you have to be a bank. And then we saw different options. In UBA, what they did was to spin off the likes of FBNH, as well as Stanbic opted for the HoldCo structure, and FCMB is also one of them. But with what we've seen with GT Bank, Access, Sterling Bank, it looks like the HoldCo guys are gradually becoming the majority again. So I think for the others, they will weigh their options. If it makes sense to them, looking at the macro situation and the opportunities in fintech, in asset management, in pension, it might not be unlikely for us to see that as well.
All right, great stuff. So what are the pros and cons of the HoldCo structure?
Well, first off, for advantages, HoldCo give you a lot of opportunity to diversify risk. You are, like I mentioned earlier, you are not susceptible to a straight line regulatory pressure. You can streamline which of your business is a particular regulation addressing. You also have some tax advantages. You can also do all sorts of businesses that you want to do. You can go into pension, you can go into asset management, fintech, and all sorts of non-traditional banking businesses. So it gives you room for a lot of flexibility. But in terms of disadvantages, clearly you are talking about the capital need. You need a lot of capital to be able to do that, because you are going to be investing in a lot of other ways. But the banks are very, very, cash rich. So that's not a problem. It also means that some of these subsidiaries will have to be, pressed hard, because how the HoldCo makes its money is by pressing the subsidiaries very hard to get its own dividend. overcapitalization, monopoly. You can also create a monopoly because if a big company that has a lot of subsidiaries under it can actually reduce cost as a result, and you can't be, a monopoly. So those are just some of the, more clearly, I think the pros definitely outweighs the cons.
Great. Does that then improve the valuation of the share price of these banks?
Well, there's a tendency for it to increase valuation. It's possible. I mean, if I take clear examples in the Nigerian banking sector, take a Stanbic, for example, most of the valuation on Stanbic is not because of the banking business. In fact, the banking business is perhaps the smallest subsidiary. The pension business as well as the asset management bit of the business, however, are quite large. They have competitive advantage in both the asset management space as well as the pension space. So valuation is a lot in their favor in that regard. But if you take an FBNH, for example, FBNH is not as well valued compared to Stanbic. And that's because they have a huge banking business compared to other segments. So it depends on how the structure is, their operational efficiency in their most profitable subsidiary. I think those are the things that will ultimately drive valuation. So I won't say it's either here nor there. It just depends on on where the money is coming from in terms of the revenue drivers of the HoldCo.
Great stuff. Okay, I want to ask you about Access Bank's expansion further into Africa. What do you make of the latest announcement for their entry into Mozambique and South Africa?
Well, I think that's great news. Most Nigerian banks want to do business in South Africa. South African market is perhaps one of the toughest in terms of competition, and maybe regulation across the continent. Many Nigerian banks are doing very well in the rest of sub-Saharan Africa, apart from South Africa. Even if you take the like of ETI, they recently just got entrance into South Africa. UBA, all these other banks that are very strong across the continent, they don't do so well in South Africa. But if Access Bank and if they can do that, I think it's great news. But they will have a lot of competition to battle with there, because the largest bank in Africa are clearly in South Africa. They are huge. They have huge total assets, and they are doing a lot of great stuff.
Is the Pan-African expansion only a revenue story? What about costs? Does going through a subsidiary like what Access Bank is doing through, I think it's HoldCo, so does that help reduce costs when you're getting into that market?
I'm not sure it really does help, reduce costs. I think it's mostly a revenue story as well as a strategic operational story. I think for Access Bank, what they really care about is the trade advantage across Africa, which can support, other lines of their revenue significantly. If you look at their financials recently, Access Bank has not been driving their revenue from core banking revenue. You've seen a lot of their revenue come from derivative assets, unorthodox revenue lines. So if they are able to do that with trade again, maybe that's what they are looking at. And if you can grow revenue significantly enough that it can cover for your cost, which is going to be huge if you are doing business across Africa, then so long as your revenue is strong enough to much more than cover your costs, I think from a pure finance point of view, you're good.
And where does since you're mentioning trade, where does the African Continental Free Trade Agreement fit into all this as far as the Pan-African expansion is concerned?
Wow, okay, great questions. Great question. Like I said earlier, strategically, I think it makes sense for Access Bank. Ultimately, when the Continental Free Trade Agreement across Africa comes in, like we've been hearing, is clearly going to drive trade. Of course, there are bottlenecks here and there, but a bank that is well positioned, stand a good chance of benefiting significantly from that, because an interconnected Africa in terms of trade is ultimately going to benefit everybody. And if you have a strong business here in Nigeria, and you're making en route into South Africa, and you now have other businesses across the continent, you are already well positioned for the continent. Nigeria and South Africa are clearly the largest economy on the continent, and having strong businesses there help you facilitate trade easily. And if that policy eventually or that agreement eventually comes true, I think strategically, Access Bank might be making the right move.
All right, Wale, only got a minute to go here. Okay, less than a minute. The President Alassane Ouattara of Ivory Coast said that the unified currency for West Africa won't happen for another 5 years. Any impact from there? In less than a minute, if you can, very quickly.
Well, I think that slows down things. If it can happen earlier, single currency is good for trade. But then again, we ask ourselves, is Africa really ready for single currency? Are the structures and the indices and the criteria in place? The answer seems like no. Maybe 5 years is even a little bit optimistic in my opinion.
Wale Olusi, Head of Investment Research at United Capital PLC, thank you so much for your time, taking us through the banking sector in Nigeria and the embracing of the HoldCo structure.